Good afternoon, everybody, and welcome to our Charities SORP Update webinar. This is the second part of our series of webinars on the new Charities SORP. So if you attended the first one or have listened to the first webinar, then hopefully some of the things that we're talking about may be familiar in certain respects, although we're going to move on and cover some different material as well. If you didn't take part in the first webinar, then you will be able to find that on our website, and we will give you a link at the end to that so you can also view that webinar at your convenience. I'm joined today by my colleague Darren O'Connor, who's a Senior Audit Manager within our Charities team, and as you'll have seen from the slides, my name is Alex Peel and I'm an audit partner within our Charities team at James Cooper Creston. So as I mentioned, the first thing we're going to do is just really update on the changes that are affecting charity accounts over the next year or so. So briefly run through the reasons for the changes that are happening and what is happening. We're then going to look at the changes that will be happening to balance sheets as a result of the new SORP, and also some new disclosures that are required under the new SORP. Finally, we're going to look at preparing for the change, so have a think about some of the things that charities, their accountants and their trustees need to have a think about in readiness for the change. Okay, so before we get into any of the detail, just some terminology. As is inevitable, really, there's quite a lot of terminology here. So I'll try and define the terms when we use them for the first time, but if you do need to refer back at any point when you view this webinar again, or you look at the slides again, then we've got some of the definitions there. Okay, so as I said, we'll start with a brief background then. So as many of you all know, UK accounting is changing. We're already into these changes now. So from the 1st of January 2015, we've got something called FRS 102, that's Financial Reporting Standard 102. And FRS 102 has replaced nearly all of the UK accounting standards. There used to be in total about 42 or 43 accounting standards, so statements of standard accounting practice, SAPs, financial reporting standards and urgent issue task force notes. They've all been combined into one accounting standard, which is this FRS 102, and that applies to company accounts from year starting 1st of January 2015. As a result of that, the FRSI has been updated. Now, the FRSI is the Financial Reporting Standard for Smaller Entities, and that has been updated, again, applicable from the 1st of January 2015, and that again applies to companies, and as with FRS 102, also other similar entities preparing their accounts under UK standard accounting rules, really. And both of the changes that we've had to the accounting standards have meant that there are some significant changes to accounting in the UK. As a result of that, clearly there doesn't want to be a position where UK accounting principles for companies are completely different from UK accounting principles for charities. So as a result of the new rules for companies, charity reporting has been updated. So what's happened then? So at the moment, or in the past, we had one SORP, SORP 2005. We now have two SORPs. We've got a SORP based on FRS 102, and that is, in theory at least, for medium and large charities. And then we've got a SORP based on the FRSI, and that, in theory, again, at least, is for smaller charities, or for charities which qualify for that as small charities. And that size is defined by criteria set out in the FRSI. But don't get too excited about having two SORPs, because it's not going to last. The frizzy itself is for 2015 only, so companies that are applying the frizzy can only use that for 1 year, for the year commencing on or after the 1st of January 2015. After that, it's being abolished and various new rules have been brought into place for companies. But because the frizzy is being abolished, the frizzy SORP is also being abolished. So again, for charities, for small charities who decide to use that standard, it will only last for 1 year. The SORP committee, which is the sort of group of people from different walks of charity life, so the Charity Commission, the charity sector, and also the accounting profession, are currently considering the different options. And the likely outcome will be that there will be one SORP. Consistent accounting and measurement principles between for small charities and medium and large charities, and then hopefully reduced disclosure requirements for smaller charities. One of the key issues in having two SORPs is that at the moment there are actually different accounting rules for small charities under the frizzy SORP from the rules applying to medium and large charities under the FRS 102 SORP. And the review and the abolition of the small charity SORP will bring that accounting into line. Okay, so before we move on, Darren in a minute will start talking through some of the significant changes resulting from the new SORP. We want to make this a bit interactive so that hopefully people don't drop off. And we've got a couple of questions for you. The first one should be on your screen now. Really, it's just based on the knowledge that you've got to date, based on your current knowledge, what effect do you think SORP 2015 will have on your financial statements? There's no right or wrong answer to this, just really based on what you've heard so far, read so far, anything like that. Some votes coming in now. I'll have a couple more seconds just while people vote. I think most people have now voted. Okay, so that's interesting. The results are no one actually thinks there'll be a significant change, and that's interesting. Okay. 86% some change and 14% no change at all. That's also interesting. That could be right. I think all charities will have some format type changes. It might be that some charities don't have any changes to their actual numbers. Anyway, what we'll do now is move on to Darren, and Darren is going to take us through changes to the balance sheet and disclosure requirements.
Okay. Thank you, Alex. So as we mentioned, and some of you will have watched our webinar back in October that covered off mainly the statement of financial activities, the SOFA, and the changes that will impact charities. So you'll have noted if you did attend that charity, there are some considerable changes to the statement of financial activities, mainly in the areas of classification, and some of the terminology has changed, basically making it easier to understand, more plain English terminology. You'll probably be pleased to know that the balance sheet hasn't really changed in format. It's still based on the Companies Act format of a balance sheet that has been amended to include fund accounting principles. But even though the format hasn't changed, some of the accounting policies have, which could mean that the carrying value of assets and liabilities held on your balance sheet may actually change. So over the next few slides, we'll cover off some of these potential changes. So in terms of investment properties, basic accounting, you would account at cost and then subsequently revalue to fair value, market value at the end of each year. The SORP 2005 permitted any reasonable approach to value in the market value. The FRS 102 and therefore SORP goes a little bit further and states that you should be using an independent expert to value the property. If you do not revalue or use an independent expert, you should disclose that in your accounts. There was an exemption due to undue cost and effort. However, under SORP 2015, this does not apply. Mixed-use investment property. So this is the situation where where the investment property might be partly used by the charity for operational use, but may also be used for investment purposes, for example, letting out a proportion of it. Under SORP 2005, you would have a look at the usage, and if you mainly used it as your operational premises where your staff work out of, then you would account for this as if it was a tangible fixed asset as a property. Likewise, if it was mainly an investment property, you were letting it out, you would treat it as an investment property. SORP 2015 takes a slightly different approach and states that you should apportion based on usage between the two fixed asset headings. So therefore, you could end up with a situation where 50% of the property is accounted for under tangible fixed assets and 50% under investment property. So this could lead to some interesting valuation or carrying value considerations. You could end up with half being valued each year at fair value, held under investment property, and half at cost being depreciated or revalued each year at market value, depending on the basis you decide. There are exemptions in this area due to impracticalities or undue cost, and if that is the case, you would then account for it under tangible fixed assets. Social investments. These are investments primarily taken out or undertook to further the charitable aims of the charity. This is also known as a programme-related investment. SORP 2015 describes a subclass known as the mixed motive investment. So this would be an investment that you take both to be in line or to further your charitable objectives, but also to make a financial return. SORP 2015 states that all social investments should be held within a separate class within investments, and within the notes you should further distinguish between programme investments and mixed motive investments. So accounting for social investments. Social investments can take many different forms, and we've listed out some of the main headings or main types there: loans, shares and property. So loans, you would account originally on the cost or the amount of the loan, and then subsequently account for the repayments as they fall due or as they occur. If the loan is greater than 1 year and is not held at a market rate of interest, or there is not a market rate of interest, you would discount the loan back to the present value. Shares and property would generally be held at fair value unless there was a reason why you would be holding them at cost. SORP 2015 does state that you should account for impairments or any impairment that occurs on social investments. So this, for example, could be taking a loan, and as an example, if repayment dates are not kept to or repayments are not occurring, that could be an indication of an impairment to a loan. Therefore, the impairment loss would go through your statement of financial activities, your SOFA. It goes further to state that if it's a programme-related investment, so this is an investment purely for the charitable objectives, you would recognise that within expenditure, the normal expenditure classification in the SOFA. If it's a mixed motive, so partly for returns, the impairment loss would be disclosed within gains and losses to investments within the statement of financial activities. So other changes to the balance sheet, or potential changes to the balance sheet: heritage assets. So this is an asset with historic or environmental or cultural qualities or characteristics, and it's held by a charity for its contribution to society. SORP 2015 states that disclosure is mandatory and it should be recognised on the balance sheet, should be accounted for on the balance sheet. It should be a separate class of asset from other fixed assets and should be recognised at cost or at market value if donated. Defined benefit pension schemes. So this is most likely to affect independent schools or any charity that contracts into teachers' pension scheme. It's for pension schemes where known as unfunded, where the actual liability cannot be accounted or cannot be separated for each individual charity, and therefore you account for it on a contributions basis. FRS 102 and therefore SORP takes a slightly different stance to what was previous accounting treatment, whereas if that contribution rate includes a proportion to make up for previous shortfalls, you should be bringing that in as a liability discounted to present value. Property let or occupied by another group undertaking in the past would have been disclosed or accounted for as fixed assets or tangible fixed assets, but now is an investment property and therefore would follow the principles that we've just previously discussed on investment properties. Debtors more than 1 year, as we've already stated, we're back on the slide with regards to loans. If the amount is more than 1 year and perhaps it's not at a market rate of interest, you would discount back to present value. The one exemption here is if it is not material. It has to be material to merit discounting back to present value. And finally, complex financial instruments and derivatives. Most likely in a charity, it could be foreign exchange, forward contracts, or interest rate swaps on a property perhaps. These need to be firstly accounted for, and they would be accounted for at fair value. There are a number of transitional rules that are listed out in the SORP. The one of note is with regards to property and other plant and equipment, but perhaps or mainly pertinent with property. Is there is transitional rules where you can carry out a once-off revaluation and then hold at deemed cost. You would then depreciate over its useful economic life, and there is no further requirement to revalue. So it's a one-off boost to the balance sheet that perhaps would be worth further consideration from a number of charities. Disclosure changes. The trustees report was covered in a lot of detail at our previous webinar, but in summary, the principles have not changed. Remember, if you're a medium-sized charitable company, you need to incorporate the strategic report into your trustees report. And there is also a clear emphasis or continuing emphasis on reserves, which is unsurprising given some of the recent failures within the charities sector. Just as a recap, the reserves policy should include a level or your target level of reserves, whether you are currently above or below that amount, and what policies or procedures you have in place to bring your reserves in line with your target level. Remuneration. The key changes with the terminology of key management personnel has been around for many years, but it's something that's really taking more focus. This could mean, well, by definition, key management personnel is anyone who can make key decisions, delegated or delegated day-to-day running of the charity. Their remuneration would need to be disclosed within the accounts. As before, any higher paid staff in bandings of £10,000 would need to be disclosed for anyone being paid over £60,000, and details of redundancies and termination payments need to be disclosed. Likewise, pension contributions do need to be disclosed to all staff members. Touching on related parties in a little bit more detail and de facto trustees. De facto trustees are essentially individuals that perhaps have not been set up on Companies House or appointed on Companies House if you're a charitable company, and Charity Commission for all charities. But you essentially assume the roles and responsibilities and act and carry out decisions as if you were a trustee. From an accounting point of view, you are essentially treated as if you are a trustee, and therefore related party transaction principles would apply, just as if you were a trustee. Trustee expenses are covered in detail within the SORP 2015, and particular mention is given to the fact that, as disclosed in the accounts, shouldn't only include reimbursed expenses. There could be expenses paid by the charity to third parties. For example, train tickets for a trustee to attend a conference or a trustee meeting should still be disclosed as trustee expenses. It also lists out within SORP 2015 a list of transactions that are not necessarily always related party transactions. For example, donations paid by a trustee doesn't necessarily have to be a related party transaction. If there were stipulations to the donation, then perhaps it would be, but not by default. And likewise, expenses waived doesn't necessarily have to be a related party transaction. But it is good practice, and we would always encourage to disclose the total within your accounts, but not necessarily the amounts to any individuals. Okay, so now that we've covered off the main disclosure changes and balance sheet changes, it'd be nice really to revisit the earlier question that Alex posed, and do you now feel that it would have an impact on your charity's balance sheet? Would the changes to SORP 2015 impact on your charity's balance sheet? So the results are coming in. We'll just give it a couple more seconds to see how we're doing. It's slightly more split than it was before, but it's still, I'll just wait a couple more moments. Okay, if we close the panel there, it is still mainly some changes, but a few now are within the significant and no change. 75% some change. So it's an interesting split, but I think it clearly shows there are changes that are going to affect all charities. So I'll now pass back to Alex, and he'll cover off planning for the future and preparing for change.
Okay, thanks very much, Darren. I should have said at the start that there is an opportunity to ask us questions. You should on your screen have a box where you can type a question in. So if you do have a question, then please do ask it, and time permitting at the end we'll try and answer it. I also probably should have emphasised more the fact that most of the things that we've talked about today arise from the FRS 102 SORP. Some of these requirements are in the Frizzy SORP, but most of this comes from the FRS 102 SORP. But as we'll talk about in a moment, I think it's probably quite likely that most charities will be using that SORP anyway. Okay, so moving on in terms of preparing for change then, as we mentioned at the start, this applies to financial periods beginning on or after the 1st of January 2015. And it won't just be that set of numbers that the new rules apply to. So if we look at an example then, say a charity that has a 31st of December year end, the first year that will apply to is the year ended 31st of December 2015. But it's also necessary to work out something called the date of transition, and then go back to that date and look at the changes from that date, at that date and from that date, in fact. So effectively, the date of transition is the first day of your comparative accounting period. So for the year ended 31st of December 2015, your comparative period is obviously the year ended the 31st of December 2014. And so the first day of that period is the 1st of January 2014. So for a December year end charity, the 1st of January 2014 is the transition date. Other common examples, a lot of charities have 31st of March year ends. So the first financial year that the new rules will apply to for those charities will be those with a 31st of March 2016 year end. And for those charities, their transition date will be the 1st of April 2014. So as I mentioned then, the opening balance sheet will need to be restated at that date of transition. So what that means is looking at the differences to the rules, looking at the new rules for accounting for various assets and liabilities, and redoing that balance sheet as if it had been done under the new rules at that date. So if you've got changes to things like the valuation of property, if you've got things like forward exchange contracts, for example, you would need to account for those differences at that transition date. Okay, we'll need to present reconciliations of funds at that date of transition. So what you'll have is a note with the old fund balances, a note with the new fund balances under the new rules, and then an explanation of the various differences which there are. So we need to do that at that date of transition and at the current year end date. So at the 31st of December, there'll be a similar note showing the fund balances under the old rules, balances under the new rules, and the differences between the two. We'll also need to produce a reconciliation of the stated surplus or deficit in the financial statements, again between the old rules and the surplus and deficit under the new rules. And the comparative figures presented in the 2015 accounts for that December year-end charity will be presented under the new rules. So it's not just the current financial year that you'll need the information for, and there could be some time that needs to be spent going back to get the information that's required. Okay, so I think in terms of considerations, probably the first one and the most important one is going to be which SORP to use. I think clearly we do have two SORPs at the moment. The changes that are arising from the frizzy SORP aren't as significant as those arising from the FRS 102 SORP. However, as we've mentioned, the frizzy SORP actually will only be around for 1 year. So if you choose to use the frizzy SORP, then you're actually just delaying the sort of inevitable, really. You will then have to change the following year to something that we're not sure what exactly the rules will be yet, but it'll be fairly consistent, no doubt, with the FRS 102 SORP. So the first consideration then is decide which SORP to use. You'll need to identify the transition date. I've mentioned a couple of common ones already, and then consider obviously potential areas of change. There are some, as we've discussed, and if you were on the previous webinar, you'll be familiar with some other potential changes. So things like holiday pay accruals, for example, a charity may need to account for the first time. So we need to go through the potential areas of change and then obviously obtain the information that will be needed. So if, for example, a property is going to be split, as Darren mentioned, between tangible fixed assets and investment property, in the past, it may have been that actually it was just accounted for as a tangible fixed asset. It would have been held at cost and depreciated. Under the new rules, if it's split, you're going to need a valuation for that property to include part of it within investment property on the balance sheet. Charities may wish to take advantage of the transition rules, which allow them to have a once-only revaluation of their fixed assets. So again, if you've got property and you wanted to do that, you could increase the strength of your balance sheet by revaluing that property. But again, a valuation would be needed to demonstrate why a certain value was used. And then, I mean, there's some of the sort of larger things, perhaps, in terms of other information needed, things like trustee expenses. As Darren mentioned, in the accounts going forward, there's a requirement to disclose both trustee expenses paid to trustees, but also paid on behalf of them. In the past, a total figure was just disclosed in the accounts, but now the requirement is that there are two figures given. One, the amount paid to trustees in respect of expenses paid back to them, and the second figure, the amount paid on their behalf, so if the charity's booked something on their behalf. So there'll be some detailed information needed in that respect. So I think that really covers what we wanted to cover today. I think the key thing is to obviously start having a think about the key issues for your charity and then to talk to us. I mean, we have been talking to clients about this in some cases for a while now. Other charities aren't so complex, and it won't be a difficult thing to do to calculate the new numbers required for the accounts. However, I think, as I mentioned at the start, all charities will have some sort of change to the format of their accounts. Even if the numbers are identical, there will be more information required and different information required to disclose. So I think that's all we had to say. I did mention earlier that if you do have any questions, then there is a chance to ask them. I've only got one question so far, and that's in respect of related parties. And the question is it correct that the amount of related party information may well reduce under the new charity SORP? If I take that one, that may well be the correct answer. As we mentioned at the start, the new SORP comes from the rules in FRS 102. And the related party transaction rules in FRS 102 have changed a bit, so that where in the past you had to disclose individual transactions with individual people or individual companies, under the new rules, actually those things can be aggregated. So if you've got a number of transactions with a class of person, so for example, in this case, you've got transactions with trustees, going forward, rather than having to disclose the individual transactions, it can be done via class of transactions. So you can just disclose the total amount in respect of trustees as a group. And that can be done in respect of other types of transaction as well, or other groups of people. Okay, there's no further questions coming in at the moment. So on that note then, all I want to say is thank you very much for listening today. You've got some useful links at the bottom of your screen. The previous webinar, as I said, is up on our website already. So if you haven't listened to that, then do have a look at that. If you have already done so, then you may well obviously want to go and refer to it again. This webinar will also be up on our website in the very near future. So do feel free to listen again, or if you've got other colleagues or trustees or anyone else within your organisation who you think may be interested, then do feel free to forward it on to them and allow them to also listen. Also, there are our contact details. So again, if you've got any queries, do get in touch either with us or with your usual contact at James Cooper. Thank you very much and have a good afternoon.
Thank you.